Welcome everyone to this Friday webinar. My name is Kamal Manocha. I represent PMS AIF World. Last week we did a very interesting webinar with Mr. Siddharth Bhaiya, who shared a pessimistic viewpoint and pessimistic stance for equities going forward in year 2024. We could not get much beyond a stance in that webinar, but the idea of doing this webinar with Abhisar Jain, who represents Monarch AIF, and he's fund manager and head at Monarch AIF and brings 14 years of experience, particularly in equity research. The sincere endeavor in this webinar is to understand from Abhisar, what is the way forward? Should one actually be pessimistic and sit on cash and wait for market to correct, or there is a way to continue making money and invest in equities going forward? We understand, yes, there is a pocket of small cap segment. I think 70% of small caps look expensive, but large caps do not look expensive. The valuations of large caps are there. At the same time, if we understand sector wise, the large sectors like financial services, IT, or other sectors like specialty chemicals, pharma, these sectors, there are many stocks that we can think of which actually have not even participated, which have not run up. So obviously, the scenario in front of us looks to be opportunistic, but at the same time, is it really pessimistic or it is optimistic? And how to kind of handle the current context and current scenario is the very practical question which every investor today would have on his mind. And to address this particular question is the sincere endeavor of this webinar. Welcome to this webinar, Abhisar. I have set the context for you. You have a presentation planned for the same. Let's continue with this webinar, seeing each and every slide and data points, and understand holistically the way forward perspective that you want to discuss with the audience today. We have audience of almost all HNI, Ultra HNI clients, and who really look forward to hearing from you. And then once your presentation is done in the first half, we will see if there are any good questions. We will take them in the second half of this webinar. Over to you, Abhisar.
Sure. Thank you, Kamal, and thanks to you and PMS AIF World for hosting this webinar. So before we dive into our presentation, as you mentioned, I would like to set the context that for sure we also kind of understand that with the way 2023 has gone for the equities in almost all segments, there are many pockets of the markets which look stretched today. So it makes all the sense to be a little cautious at this point of time, and we agree with some of our illustrated peers who have been sounding that cautious tone. Having said that, what we will do in this webinar is that we will try to dissect based on a certain data points of how the India story is panning out. And then if at all one still takes a little bit longer view, by longer I mean at least a 1.5, 2 year, 3 year view, then the case in front of us may still be of being pragmatic on the market rather than very negative on the market. Obviously, in that journey, we may get corrections immediately in the next 3 months, or we may get it during the course of that period. But overall, does it make sense to play this market through a flexi cap portfolio in a more pragmatic manner is something we will discuss. I will also try and give our audience an indication of which pockets, according to us, look very euphoric, where one needs to be very careful, and which pockets, as per us, are something where there is still a lot of value. Okay. So if Kamal, you can put up the presentation now, we can start with that context, please. Yeah, so obviously, as I said, that we will discuss why we think that at this point of time it will be better to opt for a flexi cap portfolio. So first, I would like to take our audience through the market view of that we have today, like how we think that one should approach the markets at all-time highs. Of course, we've hit the all-time high in the last few days with Nifty at 21,700. So first, I would like to brush up, something which I covered a month back in the webinar with you, Kamal, where we had, discussed about this phenomenon about the flows, okay, the DII flows and the FII flows, because one needs to appreciate that all the quick moves that we have seen this year, they have also been because most market participants have turned out to be bullish and there have been very, very strong flows. In that context, I just want to revisit the slide wherein we had mentioned that DII flows have come of age, and now the DII flows have been running in a manner wherein they are almost 2x of the FII flows in last 3-year cumulative basis and also on last 5-year cumulative basis. Even this calendar year, the DII flows are $22 billion and FII flows are $20 billion. Having said that, FII flows, remain quite significant and quite important for the India-like market. And FII flows have also made a very strong comeback in the last 2 months. So in last 2 months alone, FIIs have brought in around $8 billion out of this 20 total that you see for whole of CY23. But the main point here is that the DII flows, which are now backed by sustainable and non-cyclical SIP flows, they are making our markets, quite resilient. In terms of whenever the FI flows are a little bit weak, our markets are not falling 9 pins if the DII flows are strong and they are having a very long-term kind of view on the Indian markets. Having said that, as we showed previously, also I'm just revisiting these 2 slides from that webinar, that FIIs have continued to prefer India among all the emerging markets. So as you can see, Kamal, in the last 10 years, the FIIs have brought in a total of $70 billion in India, including this year's $20 billion. Okay, and there have been only 2 years where they have done negative flows. Whereas you see any other emerging markets, you will see at least 4 to 5 to 7 negative years, on a single calendar year basis. This shows you that, there are a lot of characteristics which are favorable from a FII point of view in the Indian markets. India market is now the 5th highest in terms of market cap. There is a lot of breadth out there with more than 400 stocks above $1 billion and more than 100 stocks above $5 billion. And we have diversity with quality. We have high private ownership. We have good ROE, ROC. We have a lot of subsectors within the larger sectors. So we have broad-based representation in the equity markets from the different sectors in the industries, which have made the FIIs like the story. So FIIs, of course, remain important. Even if DIIs are coming of age, the FII flow remains important. And they've started to make that comeback in the last 2 months as maybe they have got the signal that the interest rates are peaking, the inflation is peaking, and the Fed is all set to execute some rate cuts from next year. So the equity outlook has turned, more stable for them. I would not say great for them, but more stable. So they have started to make that comeback. Now, why is all this flows coming, in such a big manner without getting too much worried about valuation premiums, and why are they taking this long-term call, be it DIs, be it FIIs? This is because, as we have shown in this slide, that the reforms that India has been undertaking for the last now almost 7, 8, 9, 10 years, they are slowly transforming India's outlook completely. So if you talk about structural reforms, we have not done 1, 2, 3 things. We have done a number of things, be it GST, be it the PLI scheme, be it RERA for the real estate sector, revamp, be it the bankruptcy bill, be it the big corporate tax rate cuts, which we did in 2019, which is supporting all your EPS growth today, as you see, because the corporates have to pay lower taxes and they are spending and setting up new facilities which have even 15% tax rate. Then we have these PSU, cleanup on the bank side, all that NPA related stuff from the banking sector has been cleaned up. RBI has been very, very proactive. On the formalization side, digitization story is touched all of our lives. Each single one of us know about that. We daily transact so many times on UPI. Now, the low-cost data availability is changing the landscape for many businesses as such. And I'm not even counting all the other formalization efforts which have happened from Jan Dhan, financial inclusion, and things like that. And macros perspective, we always had demography in our favor, Kamal, as we all know. But now what we are getting is that we are getting a good forex reserves. We are getting a shift of savings from hard assets to financial assets, from only going to real estate, gold. We now seeing, of course, in front of our eyes how much money is coming into the stock markets by the savings getting channelized into investments. And of course, we have this global themes playing out, wherein some bit of manufacturing needs to shift out of markets like China, and India is coming into picture with this all PLI scheme. So what all this is doing is that it is setting the stage for a strong growth if you look at a 5 to 10 year view. And then effectively the reforms have gone up in both intensity as well as execution, and the structural benefits will slowly kind of keep playing out, which in my view, in some cases the FIs and DIIs are willing to take that long-term view. They see that earnings will take their time to start coming in, but all these things will create some long-term benefits. So that is one, okay, which we need to keep in mind, which we cannot discount when looking at the markets. Having said that, of course, we need to see at 21,700, which we have hit just now, what is the market factoring in. But before that, I come to that, Kamal, I want to mention this is a very, very important slide. As we all know, and we have learned over our years in the market, that ultimately markets are slave to earnings, and you cannot be disjointed from earnings or the EPS for very, very long. Otherwise, the normalization generally eventually plays out. So what is now started happening, whatever I showed you in the previous slide here in terms of the, these structural changes which have been happening, what we are seeing now is that the EPS growth cycle of Nifty has turned decisively since FY20, FY21, and now it is gaining strength. So Kamal, I want to tell you that every single year we start with a certain EPS estimate from the sell side, which you see on Bloomberg consensus, right? And as the year progresses, invariably those estimates used to get cut downwards because people used to be a little bit more optimistic than required, and then EPS never used to live up to its expectations for one or the other reason. But you will be very surprised to know that this year, in the last 6 to 9 months or last 12 months, the EPS for FY24 and 25 for Nifty has not got cut. In fact, it has gone up only on the consensus basis by some 3, 4, 5%. So what you see as 985 EPS today in Bloomberg consensus for FY24, that was, say, at the start of the year or the end of last fiscal year, more like 930, 940. The one you see FY25 1100 here was more like 1030, 40, 50. So this is very important because, finally, the corporate sector, the cleanup that has happened and the kind of opportunities that many sectors are seeing, that has helped them kind of continue their earnings momentum. And since our EPS for Nifty has already gone up to 850 odd in FY23, we are still on target to reach around 1100. As you can see, when we had this big rally in FY2 to FY7 last time, which was a very big rally, it was led by EPS CAGR also, which was around 25% at that time. It was, of course, very, very high from a low base. But at that time, corporate balance sheets were good, banking sector health was good, capex cycle was almost at its peak, and global tailwinds were also good. This time also, if you see, Kamal, on the extreme right side of the table in this slide below, again you have at least corporate balance sheet very good, banking sector health is nice, and RBI is keeping a very close tab there. Capex cycle is turned decisively, and it is looking like it will go on from strength to strength. Only global tailwinds you can question, and you can be a little skeptical of what might happen with geopolitics and possible slowdown in Europe and all. And now FIDI flow is also not a problem. So 5 out of 5 things, 4 things are again in your favor, and you're seeing a EPS CAGR. If you look from CY20 to CY25 or FY20 to FY25, it's looking at around 18-19%. Even from a FY23 base of 850, what you're looking as is some mid-teen kind of a CAGR. So because of this, what has happened is that, this is the valuation multiple at today's price, okay, from the Nifty perspective. So Nifty at 21,700 today, Kamal, if we take the previous slides, EPS estimates of 980 for this fiscal year and 1100 for next fiscal year, we are trading at 22 times trailing and 19.6 times 1 year forward. Okay. And your 10-year average is exactly in that range. This 10-year average, Kamal, is of FY14 to FY23. I have not taken this fiscal year's average in the 10-year average. And the 15-year average is 19.8 and 18. So we are at 10% premium to 15-year average. Now, my point here is that if my fundamentals are, much better placed than my 10-year average and 15-year average on an aggregate basis, because I have seen so many reforms, I have seen coming of age of investors and liquidity and the DI and the FI flows, and my corporate sector is well set up, then ideally I can at least hope to trade at a slight premium to my 10-year, 15-year average, right? Because, I'm not a weak market now. My structure, my corporate position is quite good. So see, our view is that at least on the index multiple, see, I will come in the forthcoming slides that there is euphoria and there is valuation very high in certain pockets. Okay. But at the Nifty index level, when you are 22 times trailing and close to 20 times 1 year forward, okay, and we are just limiting ourselves to FY25 here only, we're not going to FY26 and all, then you can't say that we are in a very frothy zone, at least on the Nifty level. Okay. So global issues can cause the multiples to be volatile, intermittent. Okay. And there could be some downticks. I'm not denying for any downtick, but a market may deserve to trade at a slight premium to a 15-year and 20-year average, or in line with its 10-year average, which I'm showing here. Now, with this, what is actually the problem in today's market, actually, Kamal, which is a point which needs to be made, and which I fully agree with, is that there has been massive rally in the mid and small cap indices in the last 9 months. So while Nifty at 21,700 is looking, still 20 times, but you may have pockets and you may have mid cap and small cap indices which are more towards 25 times, more towards 30 times. And then certain pockets are maybe at even 40 times, 50 times, and even with weaker fundamentals. So the burning question comes that, what to avoid and where value can be found in this current markets, in my view, rather than completely avoid the markets itself. Okay. So see, in our view, on the left-hand side, we are giving certain segments which are euphoric. So, of course, the new IPOs which are coming at high valuation premiums and are getting subscriptions like no tomorrow, it of course defies logic, Kamal. It's as if, it's a sure shot win without any risk, without any downside. And, maybe the last 7-8 days has given a quick trailer to the market participants that some issues can list at the IPO price also. People have forgotten that IPOs can list at discount or at the same price at which they're issued. So what a lot of GMP was there in those issues, but they still kind of listed and near their price or below that. A lot of stocks on new energy focused themes and renewable themes, while those themes look very exciting. Okay, but what is market doing is that they are re-rating them to today on everything best that can happen maybe in next 5 years or 7 years by 2030. So just on order wins, the market is re-rating them. There is very little focus given on how much of real cash flows will be made, how much of ROE, ROCs will be generated. So while there will be many winners which will emerge from here, but right now it is basically, just see and buy and kind of get the gain today itself. So that's happening there. As I said, in many portions of small and mid cap segments have got a very extended valuation. Even in the quality mid and small cap, some of the multiples have reached more than 50, 60 times. Certain segments of PSU stocks where historically the fundamentals and execution have been very weak. There the market is taking a bet now that the execution will improve big time. See, government being proactive and very hands-on will maybe give these guys a lot of opportunity in terms of orders, indigenization. I agree with all that. But execution is something, Kamal, which they still need to do and which you may not be able to change overnight. You have same set of people who have been running and at the helm of these PSU companies for 10 years, 20 years, 30 years. So execution will have to come, and then you have to kind of see what kind of ROE, ROCs are coming before maybe re-rating them to the extent that the market has done. And even in large cap super quality stocks that we have earlier spoken about, actually also across consumer and industrial segments, there has been some brief period of time correction, but on an absolute basis, even the multiples there in our view are still also very, very high. So then, where exactly is the market? Is it a market that, you find everything expensive, you just avoid? We don't think so. So on the right side, I'm giving, as of now, what we feel the portions where, the last 2 years CAGR have not been that great in stocks, and where there is maybe value, the companies are still quite good. So subsectors like city gas distribution, maybe even sugar to some extent. Okay. Of course, you have to dig deep on what kind of stocks you want to buy. It's not as if I'm saying the whole series, all 4 companies are great, or in sugar, all the companies made small are good. But there can be opportunities there. The companies are quite robust. The business models have been there for quite long. Regulatory landscape, it remains a little bit up and down, but it has been overall constructive for these subsectors. It's not like something negative from a regulatory or government point of view. Then certain pockets within infra like roads, water, roads have seen very little order inflow in this fiscal, so a lot of stocks have remained subdued. But if one were to assume that the election related concern is away now and the current dispensation is going to come back, then you have the best road minister, I believe, in Mr. Gadkari, who is looking to take the road infrastructure to the next level in the country. So you have many road stocks which are available at single digit P with ROEs above 18, 20, 25%. Within BFSI, obviously there are pockets where we see value, be it in select banks, be it in some wealth managers or MFIs. There is even value in our view in pockets of consumer discretionary and lifestyle kind of stocks, be it multiplexes, amusement parks, or within luxury, play this whole premiumization trend which is playing out in either autos or in other sectors and tourism plays. We also see an initial opportunity of a possible turnaround in earnings from chemicals and specialty chemicals, but it may be 3-4 quarters away or 2-3 quarters away. But that turnaround may happen because there has been a very sharp fall in the earnings of the chemical spec chem stocks. So there could be some pockets which will emerge from there, which can be a good bet, and you may have to kind of do your work and come in a little bit early because you can't come in at the exact bottom. And then within pharma also, some pockets within CRO and CDMO may look interesting. So this is the thing that we feel. And in that scenario, Kamal, what we feel is that the flexi caps are the funds which will be the ideal bet now. Because, of course, if you go with pure mid and small cap mandate, then you may not find that many pockets you have to be in. Then, some pockets which are costly also. And this is one data which DSP Mutual Fund has put out, where they have mentioned that in the last 17 years, there have been 7 years where large caps have outperformed. There have been 7 years where small caps have outperformed, and there have been 3 years where mid caps have outperformed. And also, some of these mid and small caps transform into becoming large caps company. Like now, Polycab has become a sort of a large cap company with 80,000 crore market cap. Varun Beverage has become a large cap from nowhere in the last 3 years. So what happens is that some of these companies then, kind of have a business model which will still keep on going and doing well for the next 5 years, 10 years. And you need to kind of ride them in a flexi cap mandate. So in our view, what flexi cap mandate does is that it can carefully toggle between different market cap segments. Okay. And a pure mid and small cap segment right now is looking a little vulnerable to swifter drawdowns. However, if somebody has a 5-7 year view, then he can still be okay there. And within flexi cap, our view is, Kamal, that concentrated long only funds, which you get in say an AIF setup like ours, where we do only 20-25 stocks with a balanced mix of value and growth style, that even gives us a little bit better chance rather than a much more diversified mutual fund where you'll have 50, 60, 70 stocks. So in that context, Kamal, this is just our last slide, that we have always been doing flexi cap funds only as such in the past, and we believe that at this point of time, the flexi cap fund is something which makes the most sense. So we have a flexi cap scheme which is currently open for subscription for investors, which is MNCL CCF2, where we are looking to raise somewhere around 500 to 600 crores. And it's a fund which will have a maximum of 20 to 25 stocks. The mix between large cap, mid cap, and small cap will be very carefully decided, and it will be almost a kind of an equal mix with in fact, at this point of time, large caps do having their fair share within the portfolio. And yeah, so this is what I think I had, Kamal, and maybe we can now go into Q&A and anything that you and your participant would like to ask.
Sure, Abhi sir. I think this is very insightful data. Whatever you covered with regards to valuations of Nifty is something which is quite evident, and that is where I also believe that yes, large caps and certain sectors like even private banks, IT as a sector, and specialty chemicals you mentioned doesn't look to be expensive. Now, hence the question that comes to mind is that yes, there is a segment of market which is like mid caps and small caps, which is what attracts various investors, because that market has made a lot of money in long term. We will come to large cap and other things subsequently, but foremost, let's first cover mid caps and small caps, which is expensive. Going by valuations, because that's the logic that you have used for large caps also. What is your viewpoint on the current valuations or forward PE valuations of say small caps and mid caps?
So see, as I said, Kamal, that if you were to look at the whole index level for the small cap and the mid cap index, and if you take whatever are the key indices which the NSE and BSE publishes, which is for the mid cap 100 or 150 or small cap 250. So then at the index level itself, the valuations are high, no doubt, Kamal. Okay. Because out of those 150 stocks or 250 stocks, there would be 80 to 100 stocks which have seen a massive re-rating in the last 9 months of this calendar year. Okay. And many of those stocks, Kamal, are trading with very low margin of safety, because they're discounting earnings to the extent of 26, 27. And because of that, the whole index PE would have moved from, high teens of 18, 20x to now maybe 30x. Okay. Same is the case for both mid cap and small cap indices largely now. In fact, the small cap stock now, the cutoff is reaching almost 21,000 crore, as you would have read. And the mid cap stock cutoff is reaching almost 60, 65,000 crore. So you can, imagine what kind of valuation expansion has happened when the cutoff is reaching that for a small cap stock and a mid cap index. So at the total index level, Kamal, the valuations are, of course, I think 1 to 2 standard deviations above what their past averages have been, and they look little stretched. Having said that, our point is that within that, okay, you will still find pockets, okay, which would not have done much. Like I gave you the examples, okay, because of the right reasons, like specialty chemical, because the China was dumping for most of this year and there was a lot of correction. So that space didn't go up, though it didn't correct a lot. But there are spaces which have maybe corrected also and which have not gone anywhere despite all this rally. So within even small and mid cap, we are not finding a situation where we don't have anything to bet on. We still have some pockets, but at the overall index level, we also believe that it is quite stretched in terms of the valuation, and it can see its due correction anytime. It could start next month, or it could further get extended first and then start. That nobody can judge, Kamal, precisely. It's very difficult. But at the same time, we believe that investors will do well to kind of remain guarded in certain spaces there which are very, very euphoric and which are based on very, long-term fancy numbers to be coming in, which may or may not happen.
Sure, Abhisar. So the subsequent question that comes to my mind, given your, I would say, opinion towards FlexiCap, let's cover the large cap segment. And your area of forte is quality side of, market, because, in your equity research, you're well known in fund manager for investing in quality businesses or stock identification in the quality side of market. Within large cap, if we say that valuations are attractive, there are a lot of quality stocks which have not been doing well for last 2 years, which were very well known, and they were kind of very well known as consistent compounders. But those quality stocks like Bajaj Finance, HDFC Bank, Pidilite, Asian Paints, those quality stocks, one will have to obviously identify some businesses from these stocks also to construct a flexi cap portfolio with maybe 50% allocation to large cap, which is what you're trying to do. And those quality stocks even today look expensive in terms of their valuations. So what is your view? How will you identify stocks in the large cap side, when you will construct the flexi cap portfolio?
So Kamal, see, what we have been doing always is that within the large cap space, we have generally preferred sectors or the bigger sectors, which as a sector as a whole have been little anti-consensus or ignored. Okay, like banking was one sector which was ignored for a very long time. And now maybe things have started to change. 2.5 years back, it was the auto sector which was completely ignored. And you could have many, many large cap stocks across auto, which all were kind of, available cheap. So generally what we have seen, Kamal, in the last 10, 15, 20 years of our analysis of the market is that within large cap also, there are one or two sectors which are ignored at given point of time. Sometimes it's pharma, sometimes it's auto, sometimes it's IT, sometimes it's banking. So first thing we do is that we try and find out which is the ignored large cap sector, which is a sort of an anti-consensus bet, but the valuations and fundamentals are intact. So if one were to take a 2.5 year view, then things can fall in place and the returns can be concentrated in that period in a small 2-3 month, 4 month, 5 month window, but you can make that return. So from that perspective, the BFSI space still looks good. Okay, of course, now it is getting its own due attention, and some of the valuation uptick has happened there also. See, when Nifty is at 21,700, it has moved up 3,000-4,000 points very recently. You will not have many spaces which would not have participated, Kamal. Okay, to be very frank with you, but relatively speaking, okay, BFSI still looks quite good. We are still not looking at some of those names that you mentioned otherwise on the super quality stuff, because the earnings CAGR is coming at a certain clip there and the valuations still remain very, very high. So we are still not getting the comfort of how a 15-20% IRR can come from those large caps if the earnings growth remains at only 15-20% CAGR also, because they trade at a peg of 3, 4, 5x. If the earnings growth is 15%, they're trading at 70, 80, 90 times. So we are not hunting there too much, but in that sense, whether we are looking at BFSI, whether we are looking at chemicals, whether we are looking at one or two names in cement, whether we are looking at some bit of large caps in chemicals, surely. And with that, Kamal, for a concentrated portfolio like ours, where we have to do only 20 odd stocks, and within the mid cap also, now the market cap range that I hunt in is 20,000 to 60,000 crore. The large caps, we keep it limited to say 30 to 40% even in today's scenario. Okay, we need not go necessarily to 50% only. We can be 30, 40%, and we can have some of the other larger mid caps per se. What I'm trying to say is that while mid and small cap at a complete index level looks to be very stretched, there are certain pockets there which are okay. And we can pick from those pockets. And within the large caps, maybe you have a better comfort in more pockets. Okay, and they have at least not gone to such a euphoric zone. Even those very high quality large caps, they have been going through time correction, Kamal. At least they have not gone and become further costlier. Okay, they've gone and ahead and entered a painful time correction phase where they go nowhere. and if the index keeps performing, their relative underperformance keeps building up. So that might continue in our view for the forthcoming period also in those kind of stocks in our view. So we continue to avoid them per se, but within large caps, we hunt from wherever I just told you.
Sure, Abhisar. So I'll share, one interesting data point while, you were giving your very insightful presentation. I had run one poll, and this poll has been answered by almost 175 participants. And this poll, you can see the results on the screen. I had asked, how do you see year 2024 for equities? Almost, I would say 75% people have opted for either, they see it as opportunistically, or they want to go with the flow with a long-term perspective. Only 2% people actually have a pessimistic view in 2024, and 20% people have a cautious view. Now, the question to you, you as a fund manager, you also have your own personal portfolio. So how do you approach now, going ahead in 2024? Are you booking profit as markets are rising, or you are continuing to add, I would say, in a process, if you're following any process of putting money every month? How are you managing your personal money? Because you as a fund manager will give a perspective to the investor on how to actually handle the forthcoming, I would say, disposable income that investors are creating. How to handle that?
Yeah. So see, Kamal, in such kind of scenarios, the investors need to kind of take a balanced view of how they look at things. Okay. One method is to look at a appropriate asset allocation at an individual level, and then say that, okay, at this point of time, whether in my asset allocation, I want to allocate a little bit less to equity because the valuations are looking a lot stretched. Okay. But within equities, once you're looking, okay, in my view, how I approach is that I am looking at the overall structure of market, and I'm not looking at it only from a 2024 point of view, Kamal, because it becomes very difficult to predict the markets only on 6 months, 12-month basis. Okay. See, at 20,000 also, we were maybe thinking that the correction can come anytime. But now it's 22,000. So now if correction comes from 22 to 20, you are still at 20 only where you thought initially that correction may come. It may so happen that whatever correction would come may come from 24,000 or 25,000. Then you swing to 21 and you again go to 25. So the point is that Indian market as such, the structure is quite constructive. That is something which we are firmly, now believing in. The corporate earnings cycle has started to surprise positively. What we are keeping a very close eye on is that the earnings cycle, if it starts to disappoint somewhere or shows me some signs of weakness, then I will get a little bit more cautious, Kamal, to take some money off the table. In my current asset allocation of whatever equity, it's not as if I will gain a lot by sitting in cash or by waiting for a correction. Okay. That becomes very difficult to time. On the incremental money, as you asked, what should investors do? I think it always is best to allocate capital in a staggered manner, which is through that systematic way. Lump sum investments, anybody who is trying to put in big money, new money, lump sum, needs to keep a 2 to 3 year view minimum. Okay. 1 year view, one needs to be prepared that, in 2024, you may have a very normal market with some early teens kind of a growth in terms of the stock index, or you may have a small correction also here and there. But in our view, what we are thinking about the Indian markets with the way that we have seen the earnings, we have seen the reforms, we have seen the flows, is that something big black swan needs to come again, to give you that big correction, Kamal. Okay. Otherwise, it'll be like, your normal correction, which you see every year. Every year you see the index 52-week high and 52-week low, you will see a, decently big kind of a swing in that. So that you can obviously expect, but do 1 year out and 2 year out, we can expect a higher than even 21,500 Nifty level. Why not? If your corporate earnings are going to go from 1,100 in FY25 and then maybe 1,200 or 1,300, why will you not keep going up in the index also 2 years out? So it's better to take a 2 year view at least right now rather than a 6 months, 12 months view. And asset allocation, staggered investments within equity remaining constructive on the India story, that'll be the best way to go about it, Kamal.
Sure, Abhisar. So, I'll tell you some of the other fund managers' perspective, how they kind of have a view at this point of time. There are certain fund managers who say that equity markets, if you talk about, say, Nifty, it went up from 8,000 to 12,000, and then from 12,000 to 18,000. And then, before that also, if you were to kind of plot data points, every time when a new high happens, it's generally 40 to 5% higher than the last high. Last high was 18,000, and from where correction happened, and we saw 15,000 levels also last year in May, which was a profit booking. And maybe, from current high of last high of 18,000, we could see market going up by, say, 30% to levels of 24, 25,000. And then from there could be a black swan kind of event. But obviously, small caps are expensive. There are a lot of reasons why small caps have become expensive, because in 2018, 19, 20, there was a very deep correction that we saw in small caps, and hence there was a lot of value. Plus, there are many, DIIs which have come over the last 5 years, which have led to small cap space actually, expanding a lot. So what are your views, in this context? Do you agree with this perspective or not?
So, see, I don't have this exact view of what the index should do before it peaks out. Okay, of course, we can make some corollaries from the past, like you just mentioned. Okay, what I mostly, Kamal, is always driven by is the overall fundamental setup of the market, which I showed you in terms of what all is going right for our market, and then that EPS growth coming in. The good point for me, in at least in this rally, has been that the EPS has come in. Okay, and also, Kamal, I would want to tell you that when I interact with my investors, okay, and I have been interacting 6 months back also, 1 year back also, 2 year back also. See, 6 months back, there were 2-3 key things which nobody could have predicted. Even the greatest of the great fund managers, or a normal human being, or a normal investor, okay, was not able to predict 2-3 things which have panned out the way they have, which has also led to this rally, which we should appreciate and take into account. And I will give you those 3 to 4 things. See, first thing is, with all the geopolitical tension which was going in the in the world, crude had gone and touched $100. And you would well remember, Kamal, that there were calls coming of 120, 130 in no time it is coming, and even $150 estimates had also started popping up. Okay. From there, crude has come down to $80 now. Crude falling is a big positive for India, come what may, okay, because it is an input cost for so many of my industries. So it helps my corporate EPS, leave alone the fiscal deficit angle. It helps my country, that is anyways known to everyone. But what gets sometimes forgotten is that the crude falling also helps our corporate EPS, our Nifty EPS. That is the first thing which has happened. And now nobody is saying it is going to $120. Okay, you will not see any sell side reports saying. So hopefully it should not go there. Otherwise, it will become a risk. That is the first thing which happened. The second thing which happened was that nobody was expecting inflation to all of a sudden start dropping fast, and then a consensus building that inflation will stabilize, and then interest rate cuts will start coming in a big way from Fed, because Fed was very strong in its view that it will, remain higher for longer. And now suddenly in November, December, when they have started to change course, you have seen the US markets also rallied 8 to 10%. So, globally, of course, all markets follow the cues from US markets and from the Fed. And so even though interest rates may stay higher for longer still, but the direction is now decisively changing. From increasing or staying very high for very long time, maybe first some rate cuts will come and then we will reassess. That is the second thing which has changed. Third thing is, of course, on the political side, because of this government being so reform driven, there was risk if they were not to come, or there were risks to them coming, the reforms momentum could come into question. And 6 months back, there were a lot of doubts because they were losing a few states here and there. Now, when they have won these 3 states, and again the popularity and all those opinion polls have come, it has become very clear to the market that most probably 90-95% chance they're coming back, and market has given some leg up to that also. So if those 3 things have happened, and as of now they are staying intact, Kamal, okay, my view is that from a market perspective, these are some of the significant changes, and In the meanwhile, my corporate earnings have not gone cut and they have seen some upgrade. So I need to take into account. So Kamal, I don't know where it will peak, whether 24,000 because of that maths that you told. But it is not a market where you can suddenly expect a very deep correction out of nowhere. You will need some event, yeah. Okay. Otherwise, all these things which have happened will continue to have their say. At the same time, I am not trying to advocate that the whole market, you can go and buy anything, because as I told you, as I also agree with all my peers who are sounding a cautious note here, there are many segments which are very, very stretched in terms of valuation. There is no valuation safety. So the stocks can fall 30-50% only on valuation, Kamal, leave alone the earnings, the ones which are very stretched. So investors need to keep that in mind. Now what you will see in 2024 maybe is, if you are pushing me into a view of 24 only, is that index may or may not correct big. It may correct only 5% or it may go up 10%, but you will have many stocks which may correct 20, 30, 40%. Index may still go up in 2024. I don't know what percentage. And 2-year, 3-year view looks really constructive. But stock specific corrections can be deep in certain places where there is no margin of safety. So that's what I think, Kamal.
Sure. So $1 million question, you are raising money for your FlexiCap fund. How will you manage risk in, say, 2024 or over next 2 years, given all these perspectives? Obviously, there is a question, there is a caution that you are giving. At the same time, there is a lot of opportunity in various sectors.
Yeah.
So what is the risk? Because you are raising money, and the AIF, is a 1 crore minimum ticket size, whereby you're raising entire 1 crore in one go, right? So this is not a staggered investment, whereby investor can kind of manage his liquidity and his risk, but risk has to be managed by you. How will you manage this risk over next, say, 1 year, 2 years?
So Kamal, see, as I said, our investment philosophy takes into due care the margin of safety of valuation, even when the markets are at any level. Okay. And that was the same philosophy that we have been using in the past 2 funds also. When we had raised money previously at, say, 17,800 Nifty, which was our last fund in August 2022, or when we raised our maiden fund, which was almost at, say, 12,000 Nifty. Because at any level of Nifty, Kamal, what we believe is there are certain pockets of the markets where margin of safety is very less. And there are certain pockets of the market where the margin of safety is decent for you. So I obviously indicated to you the sectors and the stocks, and you could have judged from there that, many of them are very anti-consensus today. Nobody is talking about, but it is not as if in those sectors there are not good companies which can give you 20% IRR. So there, Kamal, anyways, I'm discounting a lot of risk because I am entering at a very big margin of safety and I'm not sacrificing on quality in a big way. At the same time, we know that the pockets which are stretched have gone up in percentage. If there were only 30%, 40% pockets which were stretched 3 months back, today there are 60% pockets which are stretched. So in the first, 3 to 6 months of our investment journey in the new fund, we will be giving a due care to those kind of, issues. Having said that, Kamal, markets give you opportunities all the time. You will not know, and within 3 to 6 months, there could be changes within some sectors where, the opportunities can present itself. So our fund is a 4+2 year mandate. And once we are giving ourselves a time of between 2 to 4 years to bet, I think we will be able to manage that risk. What we have also understood is that now in the India kind of a market, with the way the outlook is building up, there will be certain valuation premium for certain stocks, which one needs to account for in his investment philosophy. And that is why you have seen also in some of the sectors in the stock, that some of your winners and some of your stocks may look to you a little bit stretched for some point of time. But then the earnings, they grow into their earnings and the stocks, and then effectively the compounding can keep on taking place. So we will continue to work with our philosophy, Kamal, and we are always risk averse in terms of overpaying for quality. We have had very strong views. That's why, which we have put out in our newsletters also, which you have seen. So we will work with that same framework, and we don't have those comms that the PSUs can't make returns, and we will just blanketly neglect them or avoid them. We work on our strategy of cash flows, incremental ROC coming, margin of safety, balance sheet strong. And then, of course, I think the risk takes care of itself.
Sure. Thank you so much for giving such a holistic perspective and view. So we move on to the last 10 minutes of our discussion, and I would like to understand from you, because this is the second series of your AIF, what has been the track record in the past, from the earlier fund, and any indication that you want to give to investors who come with a longer term horizon of 4 years in your fund in terms of future returns.
So yeah, see, Kamal, actually, we have done only 2 AIFs till now. And in fact, in one of the AIFs, we even returned the money to the investors, which is generally a little bit rare in the industry, as you know. Okay. And in that fund, aided by decent markets, we could give post-tax IRR of 23.5% in 2 years of 7 months. This is the annualized IRR that we had given. Even in the current fund, the IRR that we are having is, in high 20s, of course, because the markets have also been doing good, but we have a alpha over the benchmark that is running more closer to 10%, 1,000 bips or something. What we are trying to do is, in a flexi cap mandate, we are trying to generate superior returns to the NSE 500 or BSE 500 benchmark by a decent margin. I would not want to give an exact percentage, Kamal, as such, but what one can expect and what we expect is that once anybody is taking a more than 2-year view on this market, as I said, just a single year view, even if you were to ask me in 2022, okay, whatever view I would have given you on 2023 return, it would not have come right? Okay. Nobody expected a 25% index return and 50% small cap, mid cap returns in 2023. Did anyone on your show or anywhere else said that? Nobody, right? But it came. Now, whatever I give you for 2024, it might not come true, whatever anybody gives you. But from a 2 to 3 year, 4 year perspective, I think indices can still give, returns in teens, mid teens or early teens based on how our corporate earnings pan out. And then the good strategies which do their work well, which don't get carried away by momentum and which follow their process well, will they not generate a decent alpha over those indices? I don't think so. Why not? Okay, and that's what we feel that we will be able to do. And that's what we, as an indication, we want to give, that we feel NSE 500 at an index level can give mid-teens kind of a return, even from here, early teens to mid-teen once you take 2 to 4 year view. And then good strategies like ours hopefully can and give a good alpha, which can be anywhere between 4, 6, 7% over that indices.
Sure. So I move on to the last question of this webinar, Abhisar. So it is very difficult otherwise to manage one's own portfolio, one's own self, whereby if I have my own personal portfolio allocation towards, say, large cap, mid cap, small cap, and it is obviously a good idea to give I would say, corpus to a fund manager who can manage in the flexi cap portfolio construct. And that is what we are advocating, whereby fund manager is much more equipped to move between large cap, mid cap and small cap. But at the same time, there are investors who believe that rather than putting money into flexi cap fund, it is a better idea to select the best in each segment, that find out the best guy in small cap, best guy in mid cap, and best guy in large cap, and segregate money likewise, and not maybe invest in a flexi cap fund. And there is a question in the chat I could read, and it's come from one of our clients, one of our own clients, and hence it's important to take this question. So how will you kind of answer to this client who has asked this question that why go for a flexi cap and not handle the division between large, mid, and small on our own?
See, I don't disagree with this view and assessment that one can try that also. Okay, because Kamal, at the end of the day, what will happen in that case is that 80-85% large cap funds anyways underperform the indexes. This is the data which we have all in front of us. So first thing, what one would be assuming that is that within the large cap, whatever he's choosing, he's making that right choice. And within the mid and small, at this point of time, unless until it's a decently concentrated funds, most of the funds that I see, okay, are having 50, 60, 80, 100 stocks because the AUMs have gone up because of the flows. Okay. Even if it is a PMS and the AUMs are very large, and that's why, Kamal, we do very concentrated and closed-ended funds where we put the gate out. Okay. We don't keep taking flow in the same fund because we know if we keep taking the same flow in the same fund, we also have to go to 30, 40, 50 stocks. Okay. So then what happens in that 50, 60, 70 stocks of mid cap, small cap funds, or even 40 stocks, okay, is that if the mid and small cap indices by any chance correct in a big way, like we kind of agreed that, at the whole index level, the valuation is stretched in mid and small, then those pockets will invariably can do badly for you, if not for 5 years, at least for, near term or 1 to 2 years. So that you need to keep in mind, Kamal, which a flexi cap fund, even from a 1 year, 2 year perspective, will be able to, I think, handle well. And that in that you are choosing the right flexi cap which suits you, which gives you that confidence instead of making 3 choices. So of course, if in small mid cap you have a 5-7 year view and you have a good manager which you have figured out, no issues at all. Stay put. Why not? Just because markets have rallied, you should book profit, you should come out and wait for a better entry. It can work, it cannot work also. So I am not saying that somebody who is really strong in his head and has that 5-7 year view, who can withstand the volatility if it were to come, then it's okay. What I'm trying to tell you is that whoever is maybe looking at allocating new capital, and whoever is looking from a more balanced risk reward perspective, given how strong the rally has been in small and mid cap, he would be better off choosing a flexi cap portfolio. That's about it, Kamal. Not going very bullheaded with any as such view that this should be done or that should be done, or doing something else is going to be very detrimental. No, not that way.
Sure, Bisar. So, we'll take one more question before we wind up.
Yes.
It is a question which is kind of an educational question, and want to understand from you, on this aspect. We have seen in every bull run, a long-term bull run, a new sector emerges, and that sector generates maximum wealth. Like for example, in the last bull run of last 5 years, if we see long-term, specialty chemicals actually was one sector which kind of was a new sector which came up from bottom. Now, likewise, you have talked about in the last webinar, also in this webinar, about tourism sector. And I also see after COVID, a lot of people actually spending a lot of money on tourism. Do you see, that sector actually, coming up really well in terms of a lot of wealth creation opportunities? And what exactly you mean by tourism sector? What particular subsectors within tourism sector are you talking about? And then is it tourism or any other sector which you think, which will be one sector which will be coming from bottom to up over, say, next 4 or 5 years, when we'll see India's economy kind of going from 3.7 trillion to say 5 and 6 trillion, I'm sure some small sectors will also kind of take a lot of advantage.
Yeah, sure. Quite interesting, Kamal. So see, what we believe is that if you look at the last 10-15 year, kind of data, Kamal, that at the GDP per capita level, actually we have been, only still crawling. We are still at 2,300 GDP from say 1,000, 1,200, 10, 15 years back. So we have not been still able to we are reached 3.5 trillion in the absolute. But being 140 crore people, GDP per capita is still 2200-2300, whereas the global average is in teens. Okay. And of course, China is in high teens, and then the developed world is in 40-50K, etc. So what I believe is that first thing is that if these reforms with the way they are going, okay, and across sectors that you are seeing, and now with digitally connecting all 140 crore of us, being connected together, this GDP per capita will go from this 2200 to whatever 4, 5, 6K. It could be 1 year plus minus. Some people say 2030, 31, we should reach $5,000 per capita. I think that should happen. Now, once that happens, Kamal, generally, you will have the demand takeoff happening in the, things that you wanted to afford, but you were not able to afford earlier. Why do you think that, all this premiumization trend is happening? Be you see it in autos, be you see it in apparels? Why we all have become brand conscious? If we can afford it, we all want good things. Okay. Be it a good car, be it the good clothes, be it the good gadgets. So this premiumization and luxury thing will definitely happen. And the second thing, what will happen is that we will try and improve our lifestyle. Whether it means that, I should take 2 holidays, 3 holidays in a year. I should travel a bit. It's not just because of COVID. Of course, COVID also did that. We were locked down and a lot of people suffered. So people want to live life. But that's a very, small comment. It can last for then short term, 1-2 years. But if your GDP per capita is sustainably going to go up to $4,000, $5,000, that means we are well off. Okay. That means we can spend. So within tourism, Kamal, it is not only, I think, hotels. It can be, you have seen a massive rally in one of the luggage stock, okay, which is a direct play on tourism. Now the another luggage company is maybe up for sale. I don't know. Okay. And then there are travel operators who are a play on the tourism sector. There can be airline companies. Obviously, there are not many of them. Only one great company is there as of now with 60% market share. But I'm not giving any recommendations here. I'm just trying to, give you an idea. But my sense is that this luxury plays, this premiumization plays, and that could be across sectors. It could be something on the auto sector. It could be something on the, retail or apparel sector. And those things will kind of play out. The other thing, which can be a big thing, which in our view may play out, is something in terms of how this power demand for India takes off and how that power and utility sector plays out. So you may not have too many winners on only the generation side because it's very capex heavy. Whether you're creating generational capacity in thermal or renewable, it can be very, capex intensive and ROE banega nahi, you need to be seen. But a lot of value chain there of equipment suppliers to all that capacity creation. Because see, we are now facing a situation, Kamal, where there could be even power deficit 1 to 2 years if the demand keeps growing like the way it is growing. You're selling so many, residential flats. You're creating so many new factories with these PLI. So the demand is taking off in power. Okay. So in that power and utility sector also, what we believe is that maybe not the, only the guys creating the capacity, but from where are they sourcing that capacity, that equipment, that distribution, transmission channel, okay, and maybe the other items. So these are the 3-4 areas, Kamal, that we see that could be the leaders in the pack, wherein newer, bigger multi-baggers and bigger companies may emerge.
Thank you so much. Thank you so much. I would say, Abhisar, it has been a brilliant session. And, for all your insights and for all the, I think, insightful discussion that we have had, I think our audience also, whatever question they had put, we have asked them. Many good wishes to you for your fund. I really look forward to kind of seeing, yes, that your fund has a lot of potential for investors who are not looking for very high returns, but at the same time, stability in returns, and at the same time, alpha in returns to the respective benchmark. And that is what you're kind of offering through your AIF, which is what I understand. And your experience, particularly in equity research, gives you, I would say, a lot of experience as well as a lot of expertise in hand-picking stocks within large cap and mid cap and small cap, which would be quality as well as with a lot of margin of safety, and that is what kind of makes it relatively a superior product at these levels, especially for investors who want to deploy their future capital. Thank you everyone for joining with us on this year-end webinar for 2023. Good luck to all of you for next year. We will be again meeting next Friday for the year beginning webinar for year 2024. Thank you once again. Thank you, Abhisar, and thank you everyone for logging. Thank you.
Thank you so much, Kamal. Thanks for all the audience, and wish you Happy New Year in advance, all of you. Thank you.
Thanks.
Thanks.